Portfolio Builder members, welcome to our Tuesday Trade Alert where we play the emerging markets. Let's take a look at this week's results and then we'll look at the unusual market activity this morning. Typically we don't see bonds and stocks selling off at the same time. And if this continues unabated, we should become definitely concerned about the health of the financial system. So we'll take a quick look at that. Luckily, the way we roll, we always have put options below our key assets, and so we're not feeling much pain from this oddball market today. So, trade alert from last Tuesday through today was to be long the emerging markets ETF, which has served us very well since this whole phase one trade deal came out unexpectedly. Now, the catch is the trade deal is catching a few hiccups. It's faltering slightly. We'll see if they really pull it off or if this turns into an escalation. Got this great cartoon from Hedgeye. Finally had a brain, a heart, a home, courage, and then the China deal, a prayer. So let's look at the results and then we'll jump into the topical news. Emerging markets went from 42.80 to 43.81 for a $1.01 profit. The option caller, which protects us to the downside, took a debit of 11 cents to enter and a 17-cent debit to exit. So we lost 38 cents on the protection, or about 38% of our profit. The net result was 63 cents a share profit on 3,800 shares in our model portfolio, which is about 10% of our total portfolio, for a return of $2,394. And I have your P&L broken down for the equities portfolio to today, and you can see it's up 2% so far in November and 21.4% year to date in 2019. Now this part of the portfolio is designed to take on more risk and deliver more reward when we get the predictions right. And so in this case, we have had some sizable returns as large as 7.7% in January, 6% in June, and our worst month was in September. If we take a look at the trade allocation, this is the Tuesday portion of our portfolio, and this is how we lopside our portfolio to be a little bit overweight on equities relative to bonds. To close out the previous trade, you buy to close the 44 call, and the new trade is to sell to open the 45 November 15th call option on EEM, and then to buy to open the 43 put. So the best case is emerging markets trades above 45 next Tuesday and we hit our maximum profit. The worst case is this trade deal implodes on itself in the next week. Emerging markets tanks and we walk away with a minimum of 43 a share because we bothered to pay 14 cents for insurance. So that's a great deal. Let's look at our risk reward profile. Our maximum profit will be $111 per 100 shares of emerging markets, and our maximum risk is $89 per block of 100 shares of emerging markets. So we have a relatively tight collar that I am tightening as these prices get more and more elevated. Meanwhile, I do want to point out where we're having pain once again is in the TLT. The TLT has been immensely profitable for us this year, but over the last few weeks it has been selling off, and today it is selling off once again. The 138 put is in play now, so the TLT is below 138, and that means we have the maximum upside profit on the TLT. From here, no risk of us missing out on any profits on the TLT if the trade deal implodes and there's a rush to safe haven assets. So this allows us to continue being bullish on the equities portion of the portfolio, and there's really no more pain to be realized on the TLT this week. We'll see how it turns out on Thursday when we close out this position. Let's take a look at the charts today and see who's live. We got Ron. Good morning, Ron. So today I've pulled up charts that just look at today's data. And so we've got some oddball action going on. Typically bonds go up, stocks go down, vice versa, but they're traveling higher together. And that's the basis of our strategy when we believe the central banks are in a phase of lowering interest rates and increasing the money supply, which they clearly are. So we have to not get worried about short-term noise, but I do want to point out that what we are seeing today is a little unusual. So we can see S&P 500 has sold off a little bit, and this is based on some cold water being thrown on the trade deal overnight. Emerging markets selling off slightly. And here's what's the unusual part is we also have the TLT selling off slightly. And again, ever since it went below 138, our put option kicked in. We cannot get less than 138 a share because of that put. GDX selling off. So we have a circumstance where just about everything is taking a little pause today. And I guess just readjusting for what the markets think will happen next. LQD, that's the investment grade corporate bond ETF. And again, as long as this is above 100, credit for corporations is relatively cheap. Above 110 or 120, it's extremely cheap. So I am skeptical to go short equities for a very long period of time, as long as their ability to borrow and do stock buybacks is in place. So that's still in place. Here's perhaps the most remarkable move, which is the yuan against the dollar. This is the Chinese currency strengthening back below that line in the sand that everyone was so worried about all year, which is the conversion rate at 7. So we'll take a look at what else is going on related to that. Meanwhile, you think the dollar would be down, but the dollar continues to be strong. So the Chinese currency and the dollar are strengthening today, which is also unusual. But this could explain the small sell-off in gold, as we have the two of the larger currencies strengthening. That will make the relative value of gold sell off a little bit. And so you can see spot gold going below 1,500 today. And then meanwhile, cryptocurrencies are still floating in this strong $9,000 to $10,000 range for the key one, Bitcoin, and Ethereum is back to 190. So until all of this trade dispute is really over, I'm not ready to call it quits on the bond portfolio and bet down, nor on gold. And when we look at the big picture, really, the central bank is only kidding itself to say it thinks it can pause from here and really be fine. So we'll take a look at that in a minute. Here's the key interest rate that was dropped slightly overnight by China. And President Xi's had a bunch of speeches this week, which I have a few quotes from. Meanwhile, China needs a firmer U.S. commitments on lifting tariffs if Donald Trump wants to seal a trade deal. So they're wanting to take back some of the previous tariffs, which would be extremely bullish for equities. It'd probably bring up the CEO confidence levels dramatically. Consumer spending would probably pop back up. So we'll see if he really cows down and takes a trade deal. But in terms of Trump being able to brag that he's accomplished anything, I'm not sure he has a good argument with what I'm hearing is in this deal. And of course, we have no clue what exactly is involved, as they have kept it pretty tight. Futures dip as Global Times editor pours cold water on trade deal hopes. You can see the futures selling off. U.S. Wilbur Ross, reasonably optimistic that they can get a China deal done. Says the structural issues will mostly be in later rounds. Phase 1 deal will rebuild U.S.-China trust. This is the Chinese Communist Party's political Twitter handle. Some media reports are illogical. My understanding is that for reaching Phase 1 deal, the two sides must proportionately simultaneously remove the additional tariffs imposed since the trade war. New tariff threat is not a bargaining chip. So the U.S. is just saying we won't raise the tariffs on December 15th if you agree to agricultural purchases. And I believe the enforcement mechanism they are discussing is something around raising tariffs if they don't abide by the IP theft. So that just brings us back to where we are right now. So this really isn't shaping up to be something to brag about that I can see thus far. Treasuries are up after they cut the rates slightly, which you think would have began playing an effect in U.S. Treasuries. However, maybe China's just playing catch up now. As we've been talking about, China's been a little slow to follow suit in terms of easing interest rates and then supplying more credit into their financial system. So now we are starting to see glimpses that they may be doing that. China's services PMI drops to a 12-month low. Hong Kong business activity crashes most on record. This is a very low print at 40. Of course, it's just one small sector of their economy that they're measuring with this data point. China will adopt 5 measures to promote higher level opening up, expand market opening, optimize the framework of opening up, improve business environment, deepen multilateral and bilateral cooperation, and jointly build the Belt and Road Initiative. So a lot of speeches in China from President Xi this week. And so he is just pushing that we need to lower the tariffs and have free trade. Of course, just not for anyone who wants to sell products in China. President Xi at China International Import Expo. Global community needs to bring down trade barriers, uphold multilateral trade principles, stand firm against protectionism, unilateralism, and efforts needed to boost international cooperation. So he's just talking down all of the actions of America over the past 2 years. Meanwhile, Trump was at a rally last night, and oh boy, does he get excited at his rallies. We're so close. China wants to make a deal badly. And then someone had a pretty funny comment. So close that he's folding on tariffs to get them to sign a partial agreement, and they won't even commit to agricultural purchases. So it's becoming a vague commitment on their end. Chinese President Xi on Monday met embattled Hong Kong leader Carrie Lam, telling her the central government has a high degree of confidence in her and fully recognizes the work by her and her team. Meanwhile, just yesterday, people are throwing fire bombs at the Chinese news outlet in Hong Kong's office. So that continues to get aggravated. The Hong Kong PMI is at 39 now. So this is really just totally decapacitating Hong Kong's ability to run business as usual. And what's significant about this is that's how China has access to outside capital. If they're going to keep their growth levels even above 5%, they're going to have to continue to borrow and build this Chinese Belt and Road Initiative. So that is at a large risk rate now of being cut off of capital. Trump administration is rumored to be debating whether to remove some existing tariffs on Chinese goods as a concession to seal a partial deal. Financial Times. Beijing is pressuring U.S. to remove a 15% tariff that was imposed on $112 billion worth of Chinese goods on September 1st, ahead of signing the trade deal. Okay, so China deal is definitely in question at this point. Good morning, Tom. Thanks for saying hello in the chat. Let's take a look at some other risks in the market. And this may be something that has to do with that repo madness. We saw WeWork go from something like a $40 to $70 billion valuation down to less than 8 in a matter of 2 weeks. Uber is having a scaling problem. They have burned through $7 billion in the past 12 quarters, despite $30 billion in revenue. So we can see as their revenue grows, their losses grow as well. And these are all tied to one key bank, SoftBank, who is also tied to JP Morgan. So I'm starting to get the feeling that perhaps it's SoftBank that has some serious funding issues right now. In fact, the son, who manages this fund, is now committing some huge portion of his shares in the fund to get loans to invest back into this fund. So it does seem like this could very well be one of the key investment groups out there that's having some significant trouble. And that's been from propping up all these tech companies who lose money and giving them extremely high private evaluations and then never turning a profit. Meanwhile, today the impeachment inquiry continues. It's getting publicized, and Steve Bannon is set to testify against Roger Stone. Roger Stone was a fellow who is believed to have been in contact with WikiLeaks and helped get those emails out about Hillary Clinton in the 2016 election. He's reportedly put pressure on a witness to not testify, and also lied about his interactions with WikiLeaks. So we'll see how that all plays out. A lot of drama unfolding in the political sphere. Meanwhile, Elizabeth Warren continues to go up in the polls and is a major concern for markets if she were to become president. It shouldn't take a federal court to see Trump's tax returns. I've got a plan to require presidential candidates to release at least 8 years of their tax returns so voters can hold candidates accountable. And he did lose the court order on repeal on that just yesterday. New York Fed official, Fed market interventions have restored calm to money markets. Perhaps, but it's at a cost of around $50 to $75 billion a night being recycled over and over again. That's a lot of money. Fed's balance sheet soars to $4 trillion, above $250 billion since the repo crisis began. And so we can see QE is back in effect. They're going to tell us they're going to pause on these rate cuts, but I am very, very convinced that they will not do that they will slowly drop these rates all the way down to zero because we have so much debt. The only other option is to allow the yields to spike, and then the U.S. government can't be funded as everybody runs for the exit in the bond market. So they really are trapped. They can lower rates as slowly as possible and try to keep everyone calm. But the bigger problem are these huge deficits. Over $1 trillion of debt the U.S. is trying to sell per year. And there's just a limited amount of money out there to buy this debt at these low rates. So if they allow these rates to spike, everyone's going to run for the exit to sell their bonds. So the only alternative is to try to slowly drop these interest rates and hope the U.S. economy can grow, get above 3% GDP consistently, and then start to work down our deficits to get this under control. So we'll see if they can pull it off. Wall Street is scared because, this is from Elizabeth Warren, Wall Street is scared because the status quo is working great for them, but we know it's not working so great for everyone else. I'm not afraid to fight for a country where everyone can succeed, not just the wealthy and well-connected. So all the billionaires have been seeing this happening for quite some time. They've all been on TV for the past 2 years talking about how it's not fair and how we need to create lots of social nets, but whatever we do, don't do socialism. Just create more social nets to help out everyone. So everyone from Warren Buffett to Bill Gates to Jamie Dimon to Ray Dalio, just about every billionaire under the sun has seen this coming from a long distance. They're frightened, and they know the real risk is if you get the wrong person in control of the government, they can take all that wealth right away from you. And this is probably their worst nightmare right now. Meanwhile, Nancy Pelosi charges on, although she's skeptical of the Democratic candidates. Today we witness more of what witnesses have told the House inquiry. It was a months-long pressure campaign laying the groundwork for the president's do us a favor call with Ukraine. President Zelensky contaminating our foreign policy for his political gain. Meanwhile, protests are now happening in Chicago, also in Lebanon, Italy, France, all over the world. The big picture is that the way our central banks have inflated assets, specifically in rent cost, medical cost, college cost, while the income levels have stayed relatively flat, is creating a lot of pain for your average Joe who doesn't have these high-level jobs. They're getting to the streets, they're connecting in urban areas, and they're protesting. So this will likely continue until something dramatic changes in terms of a transfer of wealth. Trump can't block subpoena for taxes, appeals court. Be interesting to see what exactly is in there. He's been bragging that once he does release them, or once they do get out, that everyone will be impressed with how profitable his businesses are. And we'll see if that's really true or not. And that's a wrap for today's Trade Alert, guys. Let's take a quick look at what we do. And then we'll let everyone go for the day. Daily income trade alerts at noon Eastern, Monday through Friday. Our strategy does well in all market conditions, but specifically when equities markets have strong sell-offs, our portfolio really shines. Look at the December sell-off. That was a 20% move from the top to bottom, and we made 1%. 2% in January, 1.7% in February, 2.7% in March, 1.2% in April. And then shockingly in May, the market sold off 7%. We walked away with a 2.2% gain. In June, we returned 3.2%. July was our only loss, negative 1%, but that was, again, because we were protecting against a trade war breaking down. One of these days, the trade war is not just going to have a cat fight breakdown where they hiss at each other. It's going to start making bigger and stronger moves to hurt one another's country. And that's when we're going to really be happy we have this strategy in place. August, we returned 1.8%. That's when the December 15th tariffs hit the markets by shock after we were told just a month prior that we had a trade deal in the works. In fact, the same trade deal they're pitching us that we have in the books right now is the same trade deal that broke down in July and turned into a sharp sell-off of about 6% in August. September and October, we played it pretty safe, not knowing what would happen and being skeptical a trade deal would be achieved. And we made 0.3% in both those months. And here we are today, back to current, where we're being promised a trade deal, but things are starting to falter. Here's our recommendation for how to play these tough markets to weatherproof your retirement portfolio. 50% equities, while the narrative remains strong that we will have a trade deal. 40% bonds. This is our insurance against any kind of breakdown in the trade deal. Plus, looking at the big picture, we see the central banks are in a period of lowering rates and increasing the money supply by purchasing bonds. And then a 10% position in gold. That's your protection against inflation that is due to come as they continue to increase the money supply. Right now, all the money's trapped in the bond market. $266 trillion stuck in bonds, much of which is yielding a negative return. So think about that. Why would you ever pay back a loan if you're getting it at a negative yield? You just continue to roll that over indefinitely. So negative yielding debt makes no sense whatsoever. There's $16 trillion sitting in negative yielding debt. And the second these central banks try to stop lowering interest rates, everyone's going to rush for the exits, knowing that these bonds are going to lose value rapidly. So the market is stuck in a period of lowering interest rates until they can't. And the only thing that will stop them will be inflation. So that's why we have our portfolio structured in such a way. We trade the SPY ETF Monday, Wednesday, Friday with a put option below, financed by selling a call option above. And so this is our bread and butter trade with the safest equity in the world, the S&P 500 SPY. On Tuesday, we're playing a much riskier ETF, the Emerging Markets ETF. It gives us access to companies like Alibaba, Tencent, a lot of huge companies that are out in Asia. That ETF has 1,000 companies diversified. Now this represents a much smaller portion of our portfolio, and we only want to be playing emerging markets to the upside if there's not a conflict between the US and China. So the second that narrative turns sour, we can actually use our inverted option caller to bet down on emerging markets. Meanwhile, on Thursday, this is the most important part of our portfolio. It's the 20-year Treasury and the TLT ETF. So currently, we're a little underweight in bonds and a little overweight in equities, and that's because of this narrative that we will get a trade deal in a period of easing interest rates and increasing the money supply. Now, if this were to go sour and the trade deal were to break down, I would expect the SPY and emerging markets to sell off rapidly, which we are protected against because of our collar, and for our profits to be delivered from the TLT and GDX. And again, our target income is 1% a month, or $750 a month per $75,000 invested. Our average return has been just over that at 1.5%. Now, if you would like a little bit easier portfolio to follow with more risk and more reward, get rid of the SPY. Here's the same risk profile. It'll be traded almost identically, but you just don't need to trade Monday, Wednesday, Friday. It only costs $35,000 to build. You'll trade emerging markets every Tuesday at noon, and then the TLT every Thursday at noon. Meanwhile, we have a buy and hold position in GDX. Our simple 4 ETF portfolio is extremely diversified and all you'll need for retirement, income and safety, not growth or speculation. You can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. And attention non-members, we have a new offer of the week. Call Dean at 505-322-7515 if your free trial is coming to an end. You don't want to miss out on our trade alerts. Call them right now so you can get upgraded. We can find the right package for you. Call them now at 505-322-7515. And if you are a member and you don't want to pay an annual fee, consider upgrading to lifetime access. We're going to throw in 4 weeks free in our boot camp, which also has bonus trade alerts every Friday. In fact, last Friday we went long the VIX with a trade that can return 1,000%. And it is up a little bit today, so that trade is going in the right direction for us, and we'll be building into that over the next several weeks. A few reminders, tomorrow's our paid-only webinar at 2 Eastern, so if you want to check your email about an hour before 2 Eastern, you'll have the access link. And then our weekly free webinar is this Thursday. And that's a webinar where I'm going to teach you our whole strategy inside out, why it works, when it can break down, how we can alter the strategy when it does break down, and everything you need to know to follow our program. So it's very educational and well worth the time. It's not a big sales pitch, so we'd love to see you on it. And again, that's Thursday at 2 Eastern. Let's see, any questions out in the crowd while I still have you guys live? All right, gentlemen. Well, thank you so much for your time, and we will close out our SPY trade tomorrow and the TLT Thursday.